model building, so you don't have a problem. I see. So let me hear from the rest quickly before we proceed to start a lecture for today. Let me hear from a few others before starting the lecture. I have all my things ready for a great time today. So Sam, good day so far. Great. Hey, Ifwa, good to hear from you. Thank you, Ifwa. Good to see you online as well. And yeah, there are some people that are yet to come here. So far, so good. Yeah, great. Thank you. I hope you can hear me clearly. Can you hear me clearly, right? Loud and clear. Okay, good. Let me share my screen and then we get into today's business. Let me quickly share my screen so we get into today's business. Guess what we're doing? So today we getting into the financial statement business, right? We're done with the matters concerning discount rates and all that. So it's at our back. And it's good that I introduced that now because I don't want the lectures to get complicated along the way. Or maybe where we start playing with a lot of numbers, then we take a detour and start talking about capital markets. Yeah, we'll definitely be talking about capital market, but where things now get so technical, right? Start talking about risk-free rates and all those kind of stuff, sovereign defaults, and start talking about the S&P 500 and all that. That may be a lot for you to consume. So it's good I introduced that earlier. So today, we're getting into model 3. Well, Ivan, you asked a question when we are going to start a model build. So this is module 3, and this is the model build. So financial statement modeling, that is all we're going to be handling. Well, if you're like me, one thing I love to do is from many years of taking financial statements modeling and also building or teaching a lot of people in that in the professional world, and also building the models myself for diverse clients, for valuation purposes or for anything at all, and across multiple industries. I've designed a system I believe will help you to understand whatsoever we're doing, so you don't get yourself buried in the numbers or in the Excel work. And also to say, I don't think financial modeling is an issue of Excel necessarily. The whole term modeling is not just about Excel. Just imagine those times we were not having Excel. How were people doing modeling? People were still doing modeling, right? But how they were doing the modeling will be different from how we do it today. We can do it more efficiently because we have the tools available to help us do so. But those times they had to struggle, right? So it's not a matter of Excel. Depending on who you speak to, when you want to discuss modeling, they may be having different views to share. Someone who uses programming languages all through his life, maybe in pricing complex instruments like derivatives and fixed income instruments, certain individual when that individual tells you that I'm into financial modeling, you may not have to think necessarily that he's doing Excel work or modeling in Excel. He may be writing all his codes in Python, or maybe R, or maybe MATLAB or C++ or whatever, and producing wonderful results. So all those things are part of the modeling. Modeling is a matter of just coming up with a model and that accept inputs. A model is a function. You can think about model as a function that gets accept input and then produce an output. So when we started school, we've been learning about functions and all that. We have the linear equation, the quadratic equation, and all kinds of equations. Just that what we do here in the financial statement, that's the reason why many times I tend to differentiate between just seeing financial modeling and financial statement modeling. So anytime I run programs like this, I tend to use the clear term, financial statement modeling, so I don't confuse people, because financial modeling is an umbrella term. There are a lot of things that are involved in financial modeling, right? So there's a way I want to teach this and to help you understand things really well. The Excel I'm going to be using will be shared. I can promise you today, I'll trust my responsible and share all my notes. And just some few corrections I have to do there and there, right? And also get the Excel also shared, because the next time we meet, which is going to be Monday, I would want you to have the Excel by you so you can practice alongside if the need be. So I'll start with the Excel work today, but to complete the financial modeling, I'll need 2 more sessions. So that will be Monday and Tuesday, in addition to today. And so with those 2 more sections, I should be able to complete the financial modeling. And right after the financial modeling, we get into the engine of valuation. Valuation doesn't really take much time if your model is right. So once the model is right, valuation doesn't take much time to do. But again, want you to say that you're going to benefit a lot is that after the valuation, we will do simulation. It's a simulation. I will introduce the Monte Carlo simulation for the simulation of the equity values. You see that the Monte Carlo simulation actually can be used on its own as a standalone valuation tool, or can be used to evaluate valuation results. And that will give us some kind of a log normal distribution of the company's value. And you'll be able to do some probabilistic estimates and be able to say that, for instance, that I'm 90% confident that the value of this company's stock in 5 years' time will be so and so. You can make such statistical statements, right? Based on the distribution. So I will do that. Just that the Monte Carlo simulation work involves a bit of calculus work. And when it comes to those issues of calculus and probability theory, there are a lot of people tend to run away. People start getting worried and all that in terms of how complex it is. But I'm going to skip a whole lot of those things. Maybe I'll just show you a slide or two on the calculus work that is involved, and then the final result, you don't need calculus to implement it, as far as what I want to do is concerned, right? Now, so we're going to start the lecture today by looking at the general approach, right, on what you're going to be doing, preliminary work, and then at the end of the day, we're going to zero it on one particular bank. Now, so before we do this, today we'll cover the first lesson, which is on financial statement analysis. We may not finish today, and then my hope is that I can get this done by part of this done, or the rest of this done Monday, maybe halfway through the time or to the period. And there's a second half, you put it into the forecasting, and then we'll complete the forecasting on Tuesday. The whole idea is that once your worksheets are properly set, it is now easier for you to handle all this, the forecasting and others, right? Okay. So without much ado, I want to get in there. So today we're going to look at the introduction to financial statement analysis. And I presented this earlier when we were looking at the a comparison between the banks and industrial corporates, right? And let's just say in this case, maybe a manufacturing company. And I presented this particular slide for you to look at. So I brought it back again because of the relevance it has to what we want to do here. So that's the reason why I presented it back again. Now, so when you look here, you see the assets of the banks being more financials, and even arrangement is in liquidity, maybe, and the liquidity preference has been adopted in that the most liquid assets are allowed to appear first, and then the illiquid ones follow through. So in order of liquidity, right? And then if you come to the liability section, you see the dominant liability on DCB Bank's financial statement. The most dominant liability there is deposits from banks and other financial institutions. Oh, sorry, a deposit from customers. The deposits from customers tend to dominate over any other item here, as you can see. But when you move to fund milk, side-by-side comparison, the total asset side, you see property, plant, and equipment being the most dominant. Okay, you see the property, plant, and equipment being the most dominant here. And inventory and trade and other payables also dominating to a large extent. For the banks, if you want to check things like receivables and all that, maybe the closest you can think about for a bank is other assets. So other assets of a bank tend to accommodate the receivables. So the bank's balance sheet tend to maybe use the term other assets, right? You see PP here, and if I do a common size analysis now, you see the percentage asset distribution across or items on the balance sheet. If I express every item on the balance sheet as a percentage of total assets, you will see the distribution across. And so the manufacturing firms, of course, their asset has to do with the fixed assets more, the tangible fixed assets. And as you can see, PPE is about 153. In fact, in the case of fund mill, the receivables and inventory quite dominates the total, right? That's quite interesting to see. Coming to liability section for a non-bank, like a manufacturing firm, like the one we're seeing here, you see that the liabilities are mainly divided or grouped into two: the non-current aspect of the liability and the current aspect of the liability. When we get to bank or discussions that concern bank, you don't have that non-current and current distinction. And the same thing applies to the assets as well. You don't have non-current and current assets. That distinction clearly stated here. You don't have. Now, they all have equity sessions. But you see, the banking business is highly regulated. Because of the degree of regulation in banking business, the equity side have to have further disclosures that a normal bank or maybe a normal company like a case of fund milk here wouldn't have those things like statutory reserves and all those kind of stuff, right? Now, so that's just, again, a refresher of what we dealt with earlier, and which has to do with the comparison of the balance sheets of banks and the balance sheets of manufacturing firms. Let me see if there's any question here. Anything like that. No question at the moment. Good. Now let's talk about the Analyst toolkit. So put something together, and I'm calling it the Analyst toolkit. And so, yeah, when I say the Analyst toolkit, the purpose of the toolkit is for historical financial statement analysis. And the whole idea here is I want to show you that I can group the entire analysis into three. I look at profitability analysis, and here I'm using ratio analysis, right? Ratios as a tool, and under the ratios, I can group them into profitability, risk, and liquidity. And profitability, I listed some few here. I'm not in any way saying that the list is exhaustive, right? It's just some few profitability metrics that I placed here for us to have a look to start with. So the net interest margin is one, and which we'll be looking at soon. And the return on equity is another one to measure profitability. And the cost to income ratio is another one. Now, why did I select these three? Let me explain. You see, the net interest margin tells me more about asset liability management. It's about, it brings the deposits, it brings the investment securities, it brings the loans, the interest income, the interest expense all together. So all that five is played in a single ratio. You see, so we have the deposits, that is, and even six, because we even have borrowings, right? So we're looking at where the bank gets its funding from, and then where it invests the money. So the cost of securing that funding and the revenue associated with the investment made by the bank. And then when we net that off, it gives us what we call the net interest income. So if we now express the net interest income as a percentage of the earning assets, and the earning assets here means the assets that the bank invests in, the financial asset the bank invests in, that gives the bank entitlement to interest income. So here we're looking at the loans, we are looking at the investment securities, right? Now, so that's how relevant, how important the net interest margin is. So analysts tend to pay so much attention to that. Now, so when we talk about the net interest income, the attention we pay to it is that we want to see that the net interest income is stable over time. If it is improving, it's a good thing, but an improvement in net interest income tells us two sides of the story. Two type of story, okay? One side of the story is that an improvement in net interest income may mean that interest rates are rising, therefore the bank is getting more in interest income, and interest expense is not that high. And also, it could also tell us that the bank is changing its deposit mix. The deposit mix here has to do with the percentage of deposit that the bank got from, maybe from CASA, right? If the bank is getting more deposit from CASA, and by now you know what CASA is. CASA is current account, savings account. They attract almost a very, very low cost. The reason being that the current account doesn't even attract interest at all. It doesn't attract any interest cost. The savings account tend to do, but even the interest there is minimal, right? So the whole idea is that if the bank is using more CASA, then its interest cost or interest expense is going to decline. And if we have even interest income being constant or growing at almost a constant rate or something, we will still be having a higher net interest income. I have to get a lot of time to talk about net interest margin because it's a whole lot of things. And the whole idea too is that it's the most dominant driver of the bank's profitability. And the business of banking is centering around that. It's about the sustainability in the net interest income, net interest margin. Because a bank is considered to be profitable, or a bank is considered to be doing its business if it is getting the deposits and also is mobilizing the deposit and also granting loans. And that's the business of banking, right? So if the larger proportion of a bank's revenue is coming from loans and investment securities, then we are pleased to say that the bank is doing well, right? And otherwise, it's problematic if the non-interest income sources are the ones generating most of the deposit, the revenue, then there's a bit of a problem. I selected the return on equity because that's the net profit relationship with the equity. So here we take the net profit and we express it over equity. And it's quite important because investors want to know how much investment or return they are going to get on the equity they invested in the business. So that's a very important one. And this flows into valuation, right? It has a relationship with the value of the business. And ROE is a very important metric that influences a bank's valuation. So it's very important that we have the ROE here. Cost to income ratio, because the cost to income ratio will help me cover costs in the P&L, like operating expenses, personal expenses, and all other costs, impairment expenses and all that, impairment loss expense, right? All those things got also covered. So by selecting these three, I've covered almost everything. There are several other ratios that we often look at for, but then just these ones alone, it kind of like covering them. Um, the risk. Getting to risks, banking business is a risky business, right? The risk that the profitability may not be attained is must also be looked at. So, what's the probability that we're going to be enjoying the NIM or the net interest margin that we are projecting? Well, it all depends on the NPL ratio, right? In other words, the quality of the asset. And if I say asset here, I mean the loans, I mean the investment securities. Those are the earning assets. Those are sometimes we call them the risky assets, or in other words, the revenue generating assets, right? So the loans and investment securities. So we're talking here about how quality they are. It may be, in some cases, the loans may not be of good quality. And to the DDP, the investment securities, since they are mostly government issued, tend to have great credibility, right? We don't see credit risks associated with it. And to the DDP. And the argument I always make, and which I think the regulator has to start looking at, is that after the DDP program now, we are going to say that going forward, the government instruments are risk-free, for credit risk-free for financial statement purpose. But that's not quite true. So maybe something will have to be done about that, right? Because government instrument is not risk-free. We have to start associating some risk weighting to the government securities when everything is said and done. Going forward, in the DDP they are doing, but beyond the DDP period, I think something must be thought around that, because the lessons must be learned and applied to the future engagement, right? Loan to deposit ratio is a very important one that I pick here. And the basis for picking loan to deposit ratio is that now the cash reserve ratio for every bank is measured in relation to the loan to deposit. So depending on the loan to deposit ratio you have, that will determine the percentage of your deposit that you have to keep with Bank of Ghana, right? Capital adequacy ratio is always the bottom line. It is a matter of, it tells the regulator whether I have enough capital to absorb losses should they occur. So it's kind of like, so I say the backbone of the bank. And if the capital adequacy ratio collapses, then the bank, fails to exist. Then liquidity is a key thing because the bank must also run, right? When we look at the capital adequacy ratio, we are looking at capital in the longer term or solvency capital, but when we look at liquidity, we are looking at short term, right? Liquid capital. So loan coverage ratio is a key thing you have to look at for whether we have enough liquid asset to cover, stuff here like net stable fund ratio and all that stuff. We are going to delve into this later. And as I mentioned, today, Monday and Tuesday, the periods we're going to use for this. So today we're going to deal with some of them, and then Monday we'll deal with the rest. And I believe you're going to enjoy this because we'll do a lot of financial analysis on Monday. I think the first half, maybe the first hour, and beyond that period, we start the modeling. And the whole modeling has started today, but beyond that period, we'll start doing, if I say start the modeling, I mean start doing the forecasting, right? Developing assumption, doing the forecasting. And I'll also show you the methodology we're going to adopt in developing assumptions and doing the forecasting. We will be developing base case scenario, we will be developing best case scenario, and we will also be developing a worst case scenario so that we can get a value of the bank based on each of those scenarios. And that will even help us to draw in some comfort to say that, well, best case, this is what we have, base case, this is what we have, to see how the stock market value of the bank deviates from how we're going to be drawing. Let me check if there's any question in the chat box. There is nothing yet. Team, just give me 2 minutes. Just 2 minutes, please. Just 2 minutes. I'll be with you, please. All right, team, I'm back. Thanks for the patience. Thanks for the patience. Let's proceed. Now, so I was talking about some few stuff, right? So the profitability side here, I've listed them here. Please, this is how we calculate net interest margin. It's not the same as gross profit margin. Gross profit margin, we take the gross profit expressed over our sales. But net interest margin is not like this. What we are doing is you want to see the margin we are generating on assets. Okay, that's what we mean by net interest margin. The net interest we are generating on assets. In other words, when we take the revenue generated by assets, which is interest income, and we back out the cost of raising that fund to finance the is interest earning and that should be fine. And return on equity is the profit after tax divided by total equity. That's the return on equity. I didn't include multiply by 100. I didn't multiply every ratio here by 100%. Don't worry much about how you can do, right? I've noticed a lot of banks like to use tangible equity as compared to equity. Are there any differences between them? Yeah, of course, some people may want to do tangible equity. What they will do is that maybe they will take the total equity and deduct intangible assets from it. But I don't know why any bank would like to do that, because the reason why you're accounting for something as intangible assets on your balance sheet is because you think it's an asset. And by definition, an asset must generate or must have the potential of generating future economic benefits. So why will it be on the balance sheet? And then when you are calculating your return on equity, you take it out of the total equity. And the whole idea is that a lot of them just want to report good figures, right? But you see, just don't calculate it that way, right? So take the total equity and you are gone. Now, let me say something here. The best approach, even though I presented this year, the best approach always is to take the average, right? So average total equity, and the earning asset too, it should be average earning asset. And I said this countless times that when we say earning asset, it has to do with the investment securities plus the loans and advances. And then the question anybody will ask me is, which loan and advances? Is there one on the balance sheet? No. The one on the balance sheet is net assets. The net loans. That's the one on the balance sheet. A lot of things have been adjusted to arrive at that. The one I'm recommending that you should use, which is used around, is the gross loans. So where do we get a gross loans from? To get a gross loans, you must actually get into the financial statement of the entity, the annual report of the entity. Get an annual report of the entity and go to the notes. When you get into the notes, you are going to see disclosures on assets and you see loans and advances. That's where you're going to pick the gross loans. So gross loan is what you have to use. And if you don't have impairment on impairment on assets, then you have to use the investment securities on the balance sheet. But in all cases, just go and look the gross investment securities as well. All right. I think, I don't know whether there's a question here. Okay, there's no question. Now, so the total or let me talk about the cost to income ratio as well. One thing I want to say about cost to income ratio is that the way it's calculated could vary from bank to bank or could vary from analyst to analyst. That's the reason why I always advise people when I take these classes on banks that whichever method you are using to calculate anything, if you know that there are divergent views associated with the methodology, always put a note below it that I've calculated this based on so and so. There's a reason why I'm saying this. There is no globally accepted approach to calculating cost to income ratio. Even though we know the general one is take the total cost divided by total income. But I can choose to do this. I can choose to say, well, I don't want to include impairment in my work. Okay, so maybe the impairment is too high. So I want to look at total cost less impairment before dividing that by total income. Someone may say, well, not only impairment, I want to consider only cash related expenses or cash related costs. So instead of using the total cost less impairment alone, it's going to less both impairment and depreciation expense and amortization. So there are three things that are deducted out: impairment, depreciation, and amortization. Then it's going to be left with cash related expenses. So always you need to know why you are calculating what you are calculating. Okay, now, but if you just use the total cost divided by total income, it's a good thing. In fact, if it is less than 1, it tells me that we are making profits. If it is more than 1, it tells me that the bank is making losses. Because if your total income divided by total cost divided by total income is more than 1, that's the best argument to, or the conclusion to draw, that look, this bank is not doing well. The costs are more than the income, right? Now that's profitability. The risk side, like the NPL ratio is basically the non-performing loans divided by total gross loans. Okay, non-performing loans. And I mentioned that the fact that the loan is non-performing doesn't mean that interest cannot be accrued on it. It depends on the class of non-performing loan we are referring to. There are specific classes that interest can still be charged on them. The whole idea is this: when to classify something as non-performing or a portion as non-performing, several times it's a matter of statistics, right? Statistical data we have, and we can use that to project that or make an assumption on an asset like a loan to say that, well, this percentage of the loan is likely to maybe go bad or something, or could be classified as non-performing or something. They are like buckets within which we can classify some of these things. I want to say something before we proceed. This masterclass, I'm going to look at things from the perspective of an analyst that's working outside a bank. Because I'm an analyst working outside a bank, how I will view things may be different from someone that works within a bank and having access to the general ledger of the bank, having access to all the accounting information of the bank, the detailed ones. The maximum I can access now is the one disclosed in the papers. I mean the annual report. So I'm going to do my work based on that. And that's the assumption and that's the step, the approach I'm using, right? The loan to deposit ratio, I explained that a lot. The capital adequacy ratio is equal to the capital, tier 1 capital plus tier 2 divided by the risk-weighted asset. And so we're looking at whether the capital can cover the risk-weighted asset, right? The extent to which it can cover the risk-weighted asset. That's what we are looking at. We are looking at here. Now, so liquidity, like the liquid, how do you call it? The loan coverage ratio. Sorry, I wanted to say liquidity coverage ratio. I said loan coverage ratio. I have to correct that, the liquidity coverage ratio. And so high quality liquid assets divided by the total net cash outflow, 30-day stress period, right? Of course, within the next 30 days, how much are people likely to withdraw from the bank? And so how much people are likely to withdraw from the bank? If we know the demand for cash, then we ask ourselves, well, how much liquid assets do we have, like 91-day bill or something lower than that? Something which we can easily liquidate to get some money to make money available so that withdrawals can be effective. We don't have people coming to withdraw money and they don't have access to their cash. So, and also net stable funding ratio, which is the available stable funding divided by a required stable funding. We are actually going to be looking into these liquidity ratios later. I think I'm likely to look into that specifically on Monday. Those are a few things I'm going to spend time on the first half of the day on Monday, looking at as far as the financial analysis is concerned before we enter the realms of forecasting. All right. Now, the last slide here on the analyst toolkit, I I want to talk about, earlier I talked about ratio analysis. I want to talk about trend analysis. We have some time-based measures, and the commonest we use has to do with the KGA and the YOY. KGA is compounded Hello, team. I'm so sorry. I just realized. Let me check this. So my internet decided to mess my live up for some few minutes. Am I audible? Can you all hear me? Can you hear me clearly, please? Is it very clear, right? Very clear. Just want to confirm so I don't keep breaking. Very clear, right? Okay. Thank you very much. Thank you very much, guys. All right, so let me share my screen again. All right, so I was talking about trend. So KGA is a very common one, and in all our financial analysis, we do that, working for clients and all that, and it's a popular language that is understood by all. And so we have KGA, and so it's just kind of like if you have this was what I was explaining earlier. Um, Let me just put in presentation mode. And so put this in presentation mode. Okay. So kind of like if you have an amount maybe in 2021 and then you have an amount in 2023, you want to see that constant rate at which the amount can be compounded, right? And I explained this, I think some time ago. That constant rate is a kicker, right? In other words, if you take the compound interest formula and you make R the subject, that R is a kicker. That's a compounded average growth rate. But here, the only thing we're doing here is that you already know the present value, which is the yn minus 1 that I have here. Let me use the laser pointer. Okay, so you have the yn minus 1, which is the present value, and the yn is the future value, right? Then, if I have a 5-year period, then if I have a 5-year period, the number of times the item might have doubled is 4 times, or might have grown is 4 times. The growth period is always n minus 1, right? Even doing a 5-year data point, but the growth period is 5 minus 1, so it's always n minus 1. It has grown 4 times. And that's what we have here. And then, so of course, we can use these time-based things for a lot of things. We'll be using it for growth in loans and advances, growth in customer deposits, growth in revenue, and all those kind of stuff, right? That we can calculate. We can calculate using this. And again, when we come to the Excel, there's a function that help implement this. So you don't have to put all this formula for KGA, right? You don't have to put all this formula in Excel. And there's a function which is the RRI function. The RR function can help you to calculate your KGA in just a second. The graphing, we use graphs as well, and we're going to use graphs a lot. Already, I've been using a lot of graphs starting this lecture. Pie chart, bar chart, especially we use a lot of stack to bar, right? And just to show things. Graphs help in visualizing things powerfully, right? And when you're putting together professional reports, the order of preference should be this way. You present more of graphs, and so graphs, and then followed by tables, right? And the last is text. So you don't write reports and make it text heavy. You can use graphs instead, graphs and infographics, right? Graphs. So if I say graph, it includes infographics as well. Graphs and infographics, then followed by tables, and then the less preferred is text. The reason is also because a lot of people don't have to reading, and so they tend to like the graphs. With the graphs, they can just visualize the growth in loans and look at the growth in deposits, and then all those stuff, and they're cool to go compared to having to read text, right? And sometimes text could be very ambiguous, to read and understand. All right. I want us to talk about something very important here called the core banking equation. Yeah. Now, this slide is very important because I want to show you some few things here. We call this the core banking equation because remember, I told you that when you take the financial statement of a bank, like the P&L, where most of the money is coming from is interest income. And that's how it's supposed to be. The business model of a bank is built on the fact that the bank is going to mobilize deposits and then grant loans. Therefore, we are concerned about the revenue that will come from the granting of the loans and maybe the investment of the excess amount in investment securities. We are concerned about that side as well. So if we mobilize deposit and we grant loan, what's the net profit we end up making? Even before we start thinking about how to maybe subtract expenses and all that, right? So what I want to look at, and perhaps we've never heard about this before, a lot of things and the names I've given to things are things designed by me. I designed them personally, and so you may not find some of these terminologies or names anywhere. Where if you want to test it, whether there's anything called a core banking equation or something, perhaps we've never heard about it before, but I designed these things to help in the training. I look at the entire valuation stuff and I was like, okay, so when I'm designing the curriculum or program structure, these are the kind of things you need to learn, right? A body of knowledge. And to help you understand, those of you who have never worked with banks before or work with on a bank's financial statement before, and this is your first time, to help you appreciate what we're doing, sometimes you need to put these examples in these illustrations and help you to illustrate where the bank makes most of its money from. In fact, the entire business model of the bank on one slide. And that's where comes the term, the core banking equation, right? Now, so what I want us to do is we will look at how banks turn deposits into profit. And by extension, we're asking ourselves, why should banks mobilize deposits? The reason why banks should be passionate about mobilizing deposits because there's a link, a strong link between the deposit they mobilize and the profitability at the end of the day. There's a strong link. And that's what we want to look at. Again, one key aspect of what we're going to also look at is that we want to see how deposit flows into the bank and then get into its profit, right? So that's what we're going to do. So the first step, let's consider deposits of 1 million Ghana cedi. So we're considering the situation whereby the bank is able to mobilize 1 million Ghana cedi. And let's see that the bank mobilized this 100 million Ghana cedi in using two classes of deposit. The first one is CASA, current account savings account. The bank was able to mobilize 60% of the 100 million in current account savings account. So we see that clearly. And 40% by extension is mobilized in term deposit. And term deposit here is, I'm considering any other deposit apart from CASA is considered term deposit for the purpose of this illustration. So you'll see clearly that the CASA is coming at a very low interest cost compared to the term deposit. The term deposit is 8% compared to the CASA of 2.5. So you clearly see which deposit is expensive here. Now, so the deposit is taking 100 million. It's not all the 100 million that has to be loaned out. So there's a requirement that the bank must keep some proportion of the deposit mobilized with Bank of Ghana. And no interest is paid on that money to the bank. It is held there. So the bank mobilized 100 million. Let's assume that the bank's cash reserve ratio is 20%. And I mentioned this to you that the cash reserve ratio may vary from bank to bank depending on your loan to deposit ratio. Let's say the loan to deposit ratio that applies to this bank in this illustration is 20%. So when we take 20% out of the 100 million deposit, we are left with 80 million. So we are left with 80 million here. That's what I mean by 80 million after reserves. So meaning after the a portion of that 80 million is kept with the central bank. Okay, it's reserved there. And so only 80 million is available to the bank to be granted out as loans. So you start thinking about loans out. The loans out is 80 million. And then here too, let's say this is in two classes of loan. We have personal loans. This may involve personal mortgages, right? And that's taking 30 million has been given as personal loan at 25% interest rate. We keep an example really simple, right? And 50 million, which is the remaining amount in corporate loans at 30% yield or 32% interest. And so looking at these, you'll see that the bank raised 100 million deposit and 60 million from CASA, 40 million from time deposit and at their various costs. The money then gets 20% then, gets reserved, get our reserve with the Bank of Ghana as per regulatory requirements, and then 80 million now loan out, 30 million to personal loans, and 50 million to corporate loans. And so that's the business. So at the end of every year, the bank simply is going to pay 2.5% on the CASA and pay only 8% on the time deposit. But then the bank also gets to collect 25% of the 30 million from personal loan customers, and then 50 million times 30% of the corporate loans from corporations. So what will be the bank's P&L? Let's look at it. The net interest is actually the interest income minus interest expense. So that's the net interest. I suppose we're reading this net interest. Net interest income. I was trying to write NII, not NIM. I wrote the NIM. But also because I wanted to, below I calculated a NIM. So that's the reason why that is shown like that, right? So the interest income here will be the 25% times 30 million. So 25% times 30 million, that gives us 7.5 million. And then the corporate loans interest income will be 50 million times 30%, and that gives us 15 million. So 7.5 plus 15 million, of course, that is 22.5 million. So the 22.5 million here is the interest income. Now, the money was raised at a cost. So 2.5% cost on CASA of 60 million, that gives us 1.5 million. Then 8% cost on term deposits of 40 million, 40 million because 40% are 100 million, right? Or 40 million give us 3.2 million. So when you add a 1.5 to 3.2, that's going to give us 4.7 million. Then you get it subtracted from the interest income of 22.5 and divide that by the sum of the loans. You will see clearly that we are dividing it by 30 plus 50. And 30 is the personal loan and 50 is the corporate loan. When we do that calculation, we get 22.3%. So the 22.3% is a net interest margin. And then you see there's a call out column here that's saying that for every one Ghana cedi deposited, the bank makes 0.22 or 22 pesos before operating and other expenses. So the bank made this 22 cents, and is this 22 cents? I keep saying 22 cents, I mean 22 pesos. This 22 pesos out of these is going to pay operating expenses. But then, if you can see clearly what is happening here, we are doing this at the level of the bank's business model, which is what the mobilized deposit out there and the grant loans. And that's what's happening here. I think there's a question. The chart, let me check that out. Why is the bank giving us 2.5 and 8% and charging us 25.30 to 30% on the other side? That's evil. Well, let's get into that. The banks also have a bit of a concern over this. The whole idea is that with a CASA, you can get your money anytime you want to get it, right? Even today, people run savings account, you can come for your money anytime at all. So it's quite predictable for the bank. Well, the bank can make statistical argument to say that if I have 100 million, only 10% of people come for their money. They can do that, law of large numbers. But the whole thing is that your money is available to you. You can go come for it at any time, right? And that's one key reason. And the second one too has to do with risk, in that the high net non-performing loans make it expensive for banks to also give out loans at a lower cost. But think about the most obvious one. If the banks don't give you the loan, where are they sending it to? Is it not to the government? Ask yourself what rate the government is quoting. On the treasury bills, treasury bill is above 20%, and recently, right, they are trying to beat down the rate and all that kind of stuff. But look, if you put treasury bill in 20%, and you want a bank to reduce their interest on loans, and suppose the interest on loans is 15%, treasury bill is 22%, could that even happen? Maybe not, because the individuals are considered riskier compared to the government. So why would they be lending money to the government at a rate higher than individuals? So the policy rate and all that influence how interest rate is set. So whichever way you see it is the impact of the macroeconomy and how the government or the Bank of Ghana sets their monetary policy rate and how the government also borrow. This kind of crowding out effect is having a significant impact on the banks, right? However, this is just an example. It's an example, but I think it reflects also reality. Clearly, it reflects reality. Is this a good example that helps you to understand how banks make money? Is it a good example? Let me see some few things in the chat. Let me see what people are saying. Let me hear from you. Put something in the chat. Let me hear from you. Yeah, it is. Yeah, NLT. Good. I need 2 more people to say something. Makes sense. Yeah, 2 more people. So to say something. So we need some gender balance here. I suppose NLT is a male, unless otherwise stated. NLT, am I saying something different? Am I attacking you? I doubt. I'm just looking. Makes sense. As a future bank owner, yes. Oh, Nelson. Well, when you finally become a bank owner, I believe you'll be favorable a bit towards us. You know, one thing too is that the bank's overheads are quite high. The high bank overheads causing us a lot of problems as well, because the banks may have to price their loans such that they're able to cover those expenses. Clifford said it is, but they are giving a small in relation to what they are charging. Yeah, they are giving you small in relation to what you are charging, because what you are doing with the bank is not investment. You are just saving money, so it's not investment. And so they can't give you what investment products can give you. However, what the banks are forced to do, that's when they do term deposit. Term deposit, it means you will not have access to your funds like that. You may have that at a penal rate. The whole idea is that the banks also want some stability in their deposit so they can grant loans over a longer term. But if they know, like you are like me, that I can deposit the money and then withdraw it anytime I want to withdraw it without thinking about the bank's affordability, then you're in trouble. All right, so that is it for the banking equation. But based on this, I provided some peer benchmarking here. I want you to see the picture here. Look at what's happening. Now, I want you to draw some conclusion in the chart based on what you can see, the peer benchmarking between GCB and EcoBank. And just to say, for this one, I think let me just put the year there, right, at once. A moment, guys. It's 2024. I don't know why. Okay. All right. So let me just put that there quickly. So 2024 financial statement. Then let me get back again. I want to have maybe some few thoughts from you on this. So now you can see my screen. So I wanted to tell you some story. I put it in the chat. Tell me your views about this, the peer benchmarking, comparing GCB and EcoBank. What can you say about these figures? So this is the average yield on average asset yield, right? Average asset yield basically is the interest income divided by earning assets. Okay, interest income divided by earning assets. So if I take the interest income, and you know that the earning assets includes investment securities and loans, and together they generated the interest income. So if I take the interest income divided by earning asset, I get the average asset yield. So that's the average asset yield. The average cost of funds is the same as the taking the interest expense and expressing it over the total funds or the total funding of the bank, and that includes the deposit and the borrowings, right? The deposit and the borrowing. So if I take interest expense divided by that, it gives me that. So average cost of fund. And you already know the net interest margin. So based on this, tell me something in the chat. Let's use the next 5 minutes to look at that. Let's have some conversation. What do you think? Clifford said, when we are withdrawing, they still get income from that. Oh, there is a bank that 1% to be precise. Oh, yeah. Okay, thank you. That's on the other one. So let's focus on the peer benchmarking now. So Thomas said EcoBank is more profitable. How? So tell us something beyond that. Just saying it's more profitable. What can you deduce beyond that? Yeah. I want to see some things or interactions in the chat box. So far, only Thomas put something there. Only Thomas put something there. Mamla is not here today, and also, how am I forgetting another name? Is Sam here? Yeah, Sam is here. Hello, Sam. I want to see something there. I want to see something there. Now, Prince, everyone. So let me see some messages in the chat box concerning your thoughts on the peer benchmarking here, based on what we've just looked at. What can you say? What can you say when you compare EcoBank to GCB? What can you say? Okay. So, okay. I start saying, so Nelson says EcoBank's earning assets earn more than GCB's. Yeah, that's true. EcoBank is giving 27% on earning assets, GCB is giving 19%. And then we have Thomas saying he has a higher NIM as compared to GCB. Well, yes, he has a higher NIM, and then that's true. Clifford said, I think EcoBank's asset yield is higher, which means they have low NPL as compared to GCB. Oh, maybe not necessarily. Yes, to some extent, but not entirely. But yeah, it's a point I can take. Gideon said EcoBank has a more efficient operation since the NIM is greater than that of GCB. Yes, that's true. That's true. So Gideon, throw more light on what you mean by efficiency, right? Efficient operations, in which way? See first, it's obvious that EcoBank is able to make more on its income at a very low cost compared to GCB. I believe you wanted to say to make more on each asset. That is very true, very obvious. You could see that EcoBank is beating GCB both sides, right? Averagely, I mean, yeah, that's true. Then Oye said EcoBank is more profitable. Average asset yield for EcoBank is higher. Average cost of funds is lower for EcoBank. NIM for EcoBank is higher. You see that they're actually beating GCB both ways. They're able to mobilize deposit cheaply, and they also to deploy those assets to quality sectors as well. EcoBank has tier 1 capital and total assets are higher than GCB. Well, okay, so Mami Fwa is actually taking the thing from a different perspective now, which I get. The total asset is higher than GCB's own, and still they are still making this. You know, when you look at it on the market, GCB has performed EcoBank in terms of deposit just last year, 2024. But the margin is not that much. EcoBank had been leading in terms of both assets and deposit until last year. That EcoBank exceeded GCB in terms of deposit, not assets. Still, EcoBank is still higher than GCB in terms of assets. So, as again, if I said, and Nelson said GCB pays more interest expense than EcoBank, probably to attract more deposit. Yeah, so those are things we need to look into. And in the valuation process as well, guys, you need to read more about comparables. And throughout the whole thing we're going to be doing, we'll be comparing and we'll be looking at the comparables on the market to see what they are also doing compared to GCB, where we can be placing EcoBank. Clearly, here you can say that if we are to value EcoBank and GCB, you are likely to put a higher valuation on EcoBank than GCB just based on this information, right? So Sam said EcoBank raised funds at lower cost, thereby increasing its NIM. So if you see something like this, the second round of question is this. If you see something like this, and with the conclusions you guys are drawing, or the insight you guys are drawing, what will you do? For example, if you see the average cost of funds for GCB to be higher than that of EcoBank, what will be your next step? What would you do? What would you do to understand this further? What will you be looking at? What's your next step? Will you just end it here to say, oh, GCB is generating, maybe is generating or is raising deposit at a higher cost? Is that a conclusion? I think there's something more you can do to understand this, right? What will you do? What will you do? So put that in the chart again. Let's see. What will you do to understand these figures further? What will you do? I'm looking in the chart. I'm here to see comment from anyone on that. What will you do? What will be your action? Your next action? How will you be checking again to really understand the cost of funds? Will you just tell the story that way, that their cost of funds is higher than EcoBank and any there? They are earning assets. They are earning assets. So NLT, how will the earning assets actually affect the interpretation of the average cost of funds? Can we throw some light on that? If you can throw some light on that. If you can throw some light on that, please. Who else has something to say? From all that we discussed, who else has something to say? In fact, what I'm even expecting from you is on the slide. What will you be doing? I want to hear from you. What else will you do? I don't know if people have typed, and I'm here to see. Okay, good. So Siva said you can look at the loan deposit ratio. Loan to deposit ratio. Really? What can we get from there? Okay, Blessed said the various cost percentages they charge on CASA and term loans. I'll then be able to draw some insight as to why. Oh, yes, that's what I'm looking at. So the whole thing is what proportion of GCB's deposit is CASA, and what proportion of EcoBank's deposit is CASA. Okay, so maybe GCB or EcoBank is taking maybe 80% of its deposit at CASA. I think I alluded to that earlier in the lecture. About 80 to 85% or so of EcoBank's deposits are CASA, something like that. I'll have to verify again. Those figures are not off head, but I think in my previous slides, I mentioned something like that. Well, GCB's deposit, the majority may also be from CASA, but not as much as EcoBank. So they may be getting the loans at a very high interest cost. And because they are getting a loan at a very high interest cost, they may like to loan it out also at a high interest. But this is another catch. It's a matter of the non-performance of the loans as well when it comes to this. But I see the reason why I didn't accept Clifford's response fully is that it's not all loans that are non-performing that interest is deferred on. Okay, but if it is also possible that if you are granting loans to sectors that are too risky and that a non-performing loans rate is keep rising, then it means you are actually not going to make much, right? You will not be, especially if the loan is classified such that you cannot even charge interest on them. You know, some said, I will look at the relationship between loans and deposits. Oh yeah, the relationship between loans and deposits also makes a great sense. Though, but I wanted you to come up with what do you mean by the relationship and what are you looking at for? The quality of the deposit, obviously GCB may need to raise interest to get deposit. Oh yes, so in other words, GCB may be getting deposit, mobilizing deposit more from the term deposit than maybe from CASA or something, compared to EcoBank. You see, it is also possible that CASA is dominating for GCB as well, just that not as much as seen in EcoBank, right? NLT said, all things being equal, I think growth in any asset, which is the denominator, could have an effect if the numerator is there, does not change. It could affect NIM. That's that's true. That's true. It could affect NIM. But the situation is, if the denominator is growing, what could have caused the denominator to grow and the numerator is not growing? It means that they are investing in poor assets. The assets are not high quality, or they're investing in assets that have low yield. A low yielding asset could not generate enough returns, right? A low yielding asset could not generate enough return. That could be a possibility. Great, thank you, guys. Now, so this is a big thing for bank modeling, and let me say one of the biggest parts of bank modeling, because if you are forecasting a bank's financial statement and you want to even forecast only net interest margin, you need to forecast several things. Number one, you need to have a forecast for deposits. You need to have a forecast for borrowings. You need to have a forecast for loans. You need to have a forecast for investment securities. You need to have a forecast for impairment. You need to have a forecast for repayment of loan, the payment of interest, or receipt of interest, receipt or repayment of loan, receipt or payment of interest expense on the deposit and also on the borrowings. All that you must know. So think about it. By forecasting these things alone, you have done like 40% of the work. Okay, so that's the reason why the core banking equation is very, very important. Why I consider it so important, and I've included it in this slide for you to have a look at. Now, so an increase NIM, or you can increase NIM by raising loan rates, but as you increase loan rates, which is more of the interest charge on the loans, as you increase the interest, what happens is that a lot of the loan become too expensive and people may not be able to afford. And those who have afforded to, they may not be able to repay back. And because they are not able to repay back, your NPL is rising and all that, right? It leads to, or you are risking your NPL. And then lowering deposit costs. So meaning you want to facilitate or you want to promote the deposit growth through the CASA. You want to use CASA more, right? Current account, savings account more, as vehicle to grow your deposits. So you see, what the exercise we've just are undertaken is very crucial, because when we are doing valuation, these are the critical things you want to see. The sustainability of the net interest margin, or the stability of the net interest margin, is very key to valuation. So we watch that area and we pay so much attention to that side. We don't want the net interest margin to decline. We want the net interest margin to be stable, and it shouldn't be erratic as well, because interest rate volatility can cause it to be erratic. That's the reason why the work of the asset liability management team becomes very important, right? And they are the ones that will manage all these levels, right? Yeah. Good. We are done with the first side of the lesson, which is an introduction to financial statement analysis. You'll see that the way I'm approaching this is different from how you read these things in a textbook, because this is a practical work. And as a practitioner myself, I know what you need to get there. And been teaching this for some time now and building advanced models for banks and all that, I've seen a lot of these scenarios and what you really need to understand. So all that we've been doing so far had to do with understanding or an introduction to financial statements analysis. I want us to move from there and we'll look at how to read a bank's annual report. Now, and the reason this particular side, oftentimes when I'm covering it, I intend to present an annual report before you, so we go through. But because I'll be using those annual reports in the future a lot, it's not something I want to bring out now. Later, we're going to talk a lot about it. So what I'm going to be doing is that, or how I'm going to run this session is that I will take you through things you need to be looking out for, the areas you need to spend time on, right? The areas you need to spend time. When you take the annual report of any entity at all, and more importantly, the banks, because we are dealing with banks today, the key things you need to look out for, right? Now, so I want us to look at the anatomy of a bank annual report. And here, I've set a roadmap that could help you to navigate a bank's annual report. So this is a roadmap that can help you navigate a bank's annual report. So there are four aspects here I want us to look at. The first one has to do with the front matter, and which is often overlooked by a lot of people. The front matter here has to do with the CEO's letter here, and very important. And oftentimes too, you see the front matter, including things like the auditor's opinion and all that. And so the CEO's letter here is very important. It sets out the strategic priorities of the bank, right? So, for example, you may see things around maybe digital transformation, that a bank wants to be very big on digital transformation. They will start thinking about the implication of that on each valuation in terms of how that impacts the value drivers. And by extension here, we're looking at how that will impact the bottom line revenue. And also, so revenues like revenue, fees, and commission income through that digital transformation. And digital transformation could also help boost deposit, mobilization for a bank, and also the ease at which the bank will grant loans to customers and all that. It depends on the coverage of the digital transformation, but once it's digital transformation, you know it covers the entire entity. But there will be more information there for you to read. And I just use the digital transformation as an example. There are more things that will have to be considered. Then the bank will also, or the front matter component, so the annual report will also highlight things about management assumptions about the future. Okay, in terms of the GDP growth expectation, inflation expectation, and all that. The reason why this is important is that the expectations views that they express in the annual report often form basis for the actions they take in the following year. Yeah, so here you need to maybe just have some trust on management that whatsoever they are claiming is true in terms of the expectations, right? I mean, if I say it's true, they are genuine. They have genuine reason to believe that that's going to be the expectation. Then the financial statement itself. So there you see the balance sheet, the income statement, the cash flow statement. But I want to spend more time on the balance sheet and income statement than the cash flow statement. The balance sheet of a bank is a big guide there, and if not for anything, that's what you need to spend most of your time on, the balance sheet of the bank. So the loan to deposit trend, you need to look out for that in the annual report. We will be spending a lot of time on these things, right? So you also want to spend some time on the income statement. You look at things like the net interest margin drivers, and for example, that can be found on, let's say, note S. You see, I want to generalize things, because if I take several banks, their financial statement, how they report, the note numbers differ. So I have to just put something that maybe note S. When you go to note S, you are able to see the breakdown of the net interest margin, and that you see interest income and interest expense and the main drivers, right? Cost to income ratio is a key thing too. Suppose cost to income ratio is rising, we can say it's mainly due to so and so, right? You tend to make some conclusions. Okay, so if I take 2023, the cost to income ratio has increased, so it may be due to so and so. It may be a huge impairment recorded, depending on how you calculated the cost to income ratio. Or you may say something like maybe there's a salary revision to the salary structure or something, or maybe a significant expenditure is made in restructuring costs or something like that to a bank. That might have spiked the cost to income ratio. It could also mean that its income that's rather declining and not necessarily cost that is increasing, right? So you want to understand those things. We also have the non-funded income to total income. So like all these I've done here are just examples I've given. You can also look at yours and make your own statement. The notes to accounts are very critical. In fact, the most critical part of this, because the notes are below the financial statement, giving us information on the financial statement. Okay, so I also here generically, I just represented these things with note S, note S, note S. So note S can be on accounting policy. Check those accounting policies, right? On recognition of assets and all that. I mean, the loans and all that, how they're accounted for, how impairments are calculated and all that, provisions and all that, right? Loan loss provision and all those kind of stuff. You check them out. And net non-performing loan breakdown, you check them. The reason why you are checking the non-performing loan breakdown in most cases is to see the concentration of the non-performing loan. Where is it coming from most? Okay, the FS loans, you watch those stuff. You know, FS loans, you want to see the percentage of the loans granted by the bank that coming from, or maybe that are exposed to a particular currency or a foreign currency. It's good. So here you don't make decisions. Once you have things like euro, dollar, pounds, combine all of them together, their CD value, the CD equivalent of the loans to those sectors or in those currencies, the CD equivalent divided by the total gross loan, that gives you the exposure to the currency. And if it's significant, you compare to the peer bank and it's significant, and then you consider that to be highly concentrated. And that may even cause you to apply some discount to the final value you get for the bank. Okay, so you want to get these things clearly stated. Related party transactions could also affect the bank. When we look on the last two slides, when we're looking at the peer by benchmarking, we realize that the net interest income of GCB was significantly lower than that of EcoBank. People could attribute a lot of things to it. One could be that because this is a government bank, a lot of things may not be done at arm's length, right? And if GCB perhaps is allowed to operate independently, they may be doing far better than what they are doing. And that is for sure. It's one of the well-managed corporate government banks in the country. And I'm always proud of them. About their performance. They have a very formidable team and they are doing so well. And that's kudos, that's a plus to the bank. Credit risk aside, you want to look at whether they're actually hedging some of these loans, for FS loans and all that. Liquidity side, I talked about some of these liquidity metrics time ago. And even the breakdown, the breakdown of the capital adequacy ratio, you want to see where most of them, some of the things I'm saying them today like this because I'm here to get into them. So if you're confused about them, you've never seen them before, don't worry, I know you'll be confused. But we will be looking at them, like the capital adequacy ratio breakdowns and all that. We'll be looking at them later, right? Good. So these are 4 key areas, of course, you can spend time on. You can actually structure everything around them. Corporate social responsibility and those things don't really matter much. As far as bank valuation is concerned, who really cares about that? But you see that the issue here is if that's going to bring any problem to the bank, if there's a contingent liability associated with things like that, then it becomes important. Apart from that, who really cares about the CSR and all that? If there are ESG policies and you are breaching the ESG policy, and that's going to result in a liability, yes. But if you are just complying, and so far ESG policies are more compliance driven now in the country than ever. And these are my personal views, and not to say my views of even my employer. I don't think these things will affect the bank's valuation in any way at all, unless there are some contingent liabilities associated with this. Because when we start looking at the main drivers of bank's value, you don't really care about the ESG component of that. Are they going to punish you for not really excelling ESG? Maybe if you can do the basics, you are cool to go. So it gives some. People will say that, well, it will drive demand for the bank's products in the future. Well, maybe not. And also, people may say, well, ESG is broad. It could be that the bank is granting ESG compliance loans, but at the end of the day, does it show on the bottom line? If your NIM is being dragged down and all because it's ESG loan, you will not be doing well, and others will be doing better than you. You see, sometimes we need to be careful how we overrate ESG in terms of the valuation work what we're doing. We know those are boxes to be checked, but I as an individual, I'm sitting here doing this, I struggle many times to see what ESG, the impact of ESG is on the business value. It's quite a challenge each time I do. But people are still making arguments, and it's all because of how ESG is being seen as well. I think the marketing of the ESG has been done wrongly in the past, and they keep shifting the goalposts, and it's difficult to actually know what exactly they are looking for, right? Good. That's not to put ESG aside. You know, in academic world, we should be able to critique ideas and say, and critique ideas intelligently, rather than just following or maybe having a blind faith, right, on things. Okay, good. Now, I have some 5 must-read sections when you go to the annual report, and like you'll still see these XXX things kind of stuff here. So note S, where you have notes on maybe loans, what to extract, what are you going to extract from that when you open annual report? So gross loan and NPL breakdown by sector. It's quite important. You know, you want to see the sector concentration, and you want to see the sector that is driving most of the NPL, right? And if you know that this bank is or doesn't have any strategy of changing or maybe shifting away from that sector, then it means that there's so much risk in the future. And we'll even inform you as to how you maybe apply discounts to the final value, right, of the bank. So you can get some insight. I just put this here as GCP 2024 insight. Nothing really well to put here as figures or something. I just put this thing here, like something I can structure. I can structure something like this. When I'm doing my valuation or financial statement analysis, I can create something like this to guide my team, right? And so X% of gross loans are in S sector. Also, let's say 10% of gross loans are in a sector called, let's say, construction or something like that. And they are generating an NPL of so and so. NPL has increased by a percentage point, right? S percentage point since last year, something like that. So we try to understand the pain points, where the problems are, right? Deposits, so CASA versus term deposits. Those are things you want to extract from the note and deposit. And you want to look at the percentage of CASA and also whether term deposit cost has increased and by what basis point, right? 100 basis points is equivalent to 1%, 200 basis points is 2%, so 50 basis points is 0.5%, and the same one, 10 basis point is 0.1%, and therefore we can say that 1 basis point is 0.01%, right? So you're looking at risk component as well, FS exposure, loan covenant. FS exposure is a serious risk area you want to look at for. You want to see the percentage of FS loans and hedge and whether there are any loan guarantees. Loan guarantees, where they crystallize, they create problem for the bank as well. So you want to look at that again. Auditor's opinion, you can check the auditor's opinion, whether there are some emphasis of matter. You see the emphasis of matter there is something like this. The auditor is there and he's telling you that, look, I have written something in the corner there. Guy, read that part, read that paragraph I place in there. There's an information in there for you in the paragraph. Try and read it. Especially when we have the DDP issue. The DDP is a significant thing on the balance sheet of banks. So the auditor will say, well, there's a statement in the DDP for you to read, right? So DDP bond haircut noted. So of course, every auditor is expected, actually, not required, but expected to reflect this in the emphasis of matter column or paragraph. Then you also want to check compliance with BOG. So capital liquidity ratios, you want to check them, whether the capital adequacy ratio has been exceeded or not exceeded. So you want to check all these things when you look at the financial statement of your bank. Okay, I mean, you read the annual report. No question yet. So you put a magnificent lens on the note and you dig deep. I think this will be almost like my final slide on the introductory aspects on how to read a bank's financial statement. And before we move to the analysis, I want to show you this. You see, when we do the analysis, I want you to consider this as human body, right? And so I try to, show this in this format to help you get what is going on here. So now that we have mined the annual report, so let's cover what the numbers really mean. So the approach to uncovering the numbers or what the numbers really mean, I wanted to think in this term. We have the pulse, the funding stability. So here, you're looking at things like this, CASA ratio trends. Okay, so CASA percentage of total deposits has moved from so and so to so and so between so and so period and so period. Has CASA declined or CASA has improved? It's a question I want us to answer. Diagnostics that you can do here is that, relying more on a costly time deposit is a perfect diagnosis you can do to see if the bank is relying more on costly time deposit. If the bank is relying more on costly bank deposit, then the funding stability is low. But if the bank tends to rely on massively on the funding stability tends to be high when you rely on time deposit because, of course, you have the deposit maintained over time. But then also it comes at a higher cost, right? So those are kind of things we want to do. The toolkit tip here, you want to check something like, you can make an assumption like, or make a conclusion like that for every 1% drop in CASA, then every 1% drop in CASA may be financed maybe from the time deposit sources. And you want to see the amount by which the interest expense may rise for every 1% drop in CASA. You may not want to go deeper into things like that, but the message here is that you want to see the proportion of deposit that is CASA and want to also see whether time deposit cost has increased significantly over the years. And you want to see that, or whether it's declining. And if the percentage of deposits in CASA is increasing, it's a good thing, but it may also affect the stability because what if people start withdrawing their money? But of course, the banks know how to do their business, right? They always know the percentage or they know the demand. The blood pressure side is equivalent to the asset quality, the quality of the asset. So here is the NPL hotspot. So you want to see the FS loans, the percentage of NPL that is in the FS loan. So what percentage of FS loans are non-performing? And also you want to see the risky sector as a percentage of gross loan. So let's say 40% gross loan is to a particular risky sector. And a risky sector by definition here, the way I'm using it here, mean the sector with the highest or with higher NPLs. It could be a sector with higher NPL with the bank, as far as the bank is concerned, or a sector with higher NPL for the entire banking sector. If the industry is reporting a high NPL from there and the bank is not doing it, it means that the bank may be doing things better in that sector. But if the industry is reporting a lower NPL for the sector, and then the bank is actually reporting a high NPL, it means the bank may not be packaging its loan for the sector properly. So those are things you need to pick out, right? For example, construction sector tends to, be very risky. Let's say it has 35% NPL. That's a problem, right? 60% of assets allocated to securities in 2024 is something you can look at for. Maybe 60% of the assets, the earning assets of the bank are allocated to investment securities. Is concerned. It means that almost maybe only 40% is going to loans. And that may not be sustainable. Maybe you are still buying a lot of government securities, right? And it may create problems later if the government defaults now, like what we had in the DDP side. So your exposure to government securities is still high. So what's the message here? Concentration risk needs a surgery, right? Now we have to look at that. So we don't want to have the bank's assets highly concentrated in a particular sector. Okay. Now we can consider the revenue mix as the respiratory rates. Now, income sources for a bank or revenue sources here, we have interest income, we have fees and commission and net trading, right? So if 70%, if interest income constitutes 70%, and we know interest income is sensitive to interest rates, then we will say that the interest income or the bank is vulnerable to rate hikes. So if there are rate hikes, then the bank is likely to face trouble. Now, suppose fees and commission is 25% of total income. Then let's say EcoBank has 30% of total income and GCB has 25% of total income. Then how do we say? We will say that this indicates that, if I say of total revenue, not total income, total revenue. We will say that this indicates maybe generally some digital lag at GCB, right? Maybe GCB is not really catching up. EcoBank is making a lot of money in digital space. The fees and commission from the use of the how do they call it, the apps, the banking apps, and all those kind of stuff, the ATM and all that, right? Now, so you can draw some conclusions, but the numbers I'm using here are just for illustration purposes. They are not true numbers, right? Now, one thing you need to know that net trading income is a very volatile income source, because this depends on FX trading, fixed income trading, and all stuff. And so if you have a high proportion of your revenue dominated by the net trading income, then there's a problem, because it means the entire revenue is going to be swinging over time, right? The temperature here will be used to, but it's something I'm calling here the cost fever, right? Temperature. So the temperature is high, it means the cost is really high. So we measure the cost fever. Suppose we looked at 2024 numbers and staff cost is high, is up by, let's say, S%, that may cause a problem. The diagnosis could be that economic hardship necessitating revisions in salary level. That's why that happened. Okay, economic hardship. So the banks want to revise their salaries and all that stuff. And then we can call a capital now, which is there, the bone side, as a bone density. So the capital adequacy ratio trend, if it is dropping, then there's concern. I expect generally that the capital adequacy ratio dropped in 2022 because of GDP. And that's my problem. For me, if I see that, I don't consider that as a big problem. But my problem is what happened afterwards. Before the GDP and after the GDP, the pre and the post, that's what most of my problem is going to be like. And I also want to see the percentage of capital that got eroded by the DDP haircut, right? Good. Let me check if there's any question. There's no question. Now, before we move, we are going to move away from reading the financial statement to modeling. So how do we transition from reading the financial statement to the modeling? As I mentioned to you, I'm taking these things step by step. I don't want to jump to modeling when I'm not done taking you through what you need to do before modeling. Now, so I've come up with 4 pillars of a good data book. You need to put together a data book. A data book, so the annual reports, you now translate it into Excel and ensure that the notes are aligned, the figures are summing up in the note and linking them to the financial statement. I mean the historical financial statement. That gets you prepared for the financial modeling. So the data book have to be prepared, and you all know what a data book is, right? Now, so in a typical data book for financial model build, and here, guys, I'm not talking about for valuation, I mean just for financial model build, before we add a valuation to it. You will tend to see the financial statement, and this is what I recommend, and this is what I'm going to be using. You tend to see the financial statement, and you see those structured into various worksheets, and you have historical analysis, you have model assumptions and scenarios, and as another section in the, so historical analysis will be a section in the worksheets, or workbook, sorry, and model assumptions and scenarios will be another section in a workbook, and then financial statements or projections, or just simply financial projections will be there, and then model output analysis will be there. So the historical analysis is where you analyze the CAGR, the YOY, the ratios, and all this kind of stuff, right? Good. Then a model assumption scenarios, this is where you build assumption based on history, based on macroeconomics, based on industry, and based on management view, right? You build that. And as I mentioned, we'll be building 3 scenarios. And then the assumptions also involve projections of the various line items on the financial statement. You put all those 2 things together in the financial projections, and you have the model output. The model output here, you have the ratios. Then you have to compare. This is where you do what we call model optimization. And I'm going to do model optimization with you. And a lot of people don't know what model optimization is. A lot of people don't know. You see, when you work for the manufacturing firms or you build models for manufacturing firms, it's easier to build because you don't got to do a lot of optimization work. But optimization work is going to happen with the banks. financial institutions, because of the regulations they have, there are some ratios that must not exceed some limit. There are some that must be in a certain range. And so the optimization will ensure that all those objectives are achieved. The form of optimization we're going to do here is not like your traditional optimization, like the linear programming or those kind of optimization where you want to minimize the errors and code kind of stuff. No, that's not what I'm talking about here. I'm talking about objective-led optimization, in that we have an objective that maybe gross profit shouldn't grow beyond a certain level. Maybe loan to deposit ratio shouldn't exceed a certain range. Maybe cash to deposit ratio should exceed a certain range. Maybe you want to maintain investment securities to total loans to be in a certain range. Maybe cost to income ratio should be in a certain range. Maybe non-funded income to total income to be in a certain range. Return on equity should be in a certain range. And maybe we are using the top 5 banks as a benchmark. And we are saying that in our projection, we shouldn't go beyond some limit. Okay. Modeling bank is no joke. It's not, look, building an initial model is not a problem, but optimizing a model is what a problem is. So we want to get a model optimized. So we look at the output. If the output is not how we desire, we go back to the analysis again. We revise our assumption until we get something that makes sense, right? Peer benchmarks are very important. And throughout this lesson, the program, we're going to be making good use of the top 5 banks' performance. By extension, sometimes we look at the top 10, but we're going to focus a lot on top 5 because of the banks whose value we are going to be estimating. Macro linkages, very important. GDP growth rates, inflation exchange rate will all be played out because we need this rate to justify the growth rates in deposits and all that, right? Relationship between the bank's financial statement and macro factors, like for currency depreciation and NPLs, we need to structure some relationship between them, right? Management commentary is very important. The CEO's growth targets versus actuals, the risk appetite statements and all that. They're all going to guide us in developing assumptions, right? So you want to prepare a good data book. And in the data book, there should be, in Excel, there should be 4 sections for the financial model build. A financial statement section, the peer benchmark section, macro linkages, then the last one being management commentary. They should all be in the Excel. And for reference purposes, it form basis of your working papers. They are part of the working papers, sorry. Good. Now, we are going to start. Before we do, I want to quickly check on you. Maybe let me see something in the slide, in the chart. Can I see something in the chart? About your understanding so far, whether that set the context right for you, and how excited are you about what we are coming to do next when we start historical analysis? Excellent, from Clifford. Let me hear more. Let me hear more. Let me hear how you're doing, how you're faring so far. But today, whether that set a good context before we start. I need 2 or 3 more persons. Okay, Prince said, great background ahead of modeling. Nas said, good so far, relatable stuff. Ibrahima said, good so far. Oye said, we are good, looking forward to more. Thank you. Now, going forward now, we're now going to narrow down the argument and zero it on a bank. And that bank is what we're going to be using going forward. Which bank is that? Let's say 1, 2, 3, GCB. So we're going to be working with GCB going forward. And someone very practical. Thank you, Ifwa. We're going to be working with GCB going forward, a GCB bank snapshot. So I put a summary of GCB performance so far here. And you see the establishment of the bank in 1953. That was when the bank was established, before even Ghana had independence. And the ticker symbol of the bank is GSE column GCB. And so this is, GCB is listed on the Ghana Stock Exchange market with this ticker symbol. I was putting these slides together on Wednesday. And as of Wednesday, the share price, and I need to actually indicate this here so that nobody thinks the current share price is this. The share price was 7.4 cedis per share. And the government has about 21.4% stake in a bank, and that's the largest, 21.4% stake in a bank. I want to classify that for now as the largest, right? The bank has a total asset of about 42.58 billion. Yesterday, I was looking at something on LinkedIn. I think there's one site that they're looking at the top 10 banks in Africa with the largest. And I looked through, I was like, hey, I didn't see GCP, let me check. With the largest asset base. And these assets are converted to dollars and they're reported. So you see the likes of Stanbic. Stanbic is the largest Stanbic group. Access Group also happen to be part of that. We have the Net Bank, the Net Group. And then AFSA was also part. I didn't see GCP. So, you know, I was wondering why GCP wasn't there. So I went back to check GCP's total. I was like, I don't understand why GCP wasn't there. So people are reporting total assets in billions of dollars, 100 billions of dollars and all that, right? Now in loans, 24% of the total assets is in loans. 24% of the total assets is in loan, 31% in investment securities. And then I'm quite wondering, 24 plus 31 is 55. So only 55% of the assets are earning assets. And you're wondering, why not more? Why not more than that? Okay, of total assets, because this is a bank, right? Deposit is 34 billion, and the loans out of that now about 11 billion. When you do that calculation, you see 11 billion. Profit before tax recorded in 2024 about 1.91 billion. So they're doing well in terms of profitability. The loan to deposit ratio for the bank is 35%. That's 0.35. In other words, for every 1 CD of deposit, 35 pesos is given out as loan. And so even if you look at a deposit, but GCB, just imagine 91% of the deposit is CASA. So guys, you see the argument we're making earlier. So there's an issue. And when we take a deep dive into GCB's financials, we may be able to compare that to EcoBank to see why is it that GCB still have a larger portion of its deposits in CASA and still their cost of deposits is higher. We may uncover that. If you come to the loans, about 89% of the loans are term loans. Okay, 89% of the loans are term loans. Look at the return on equity GCB generated, 32%. That's quite significant. In fact, the top 5 banks in the country, EcoBank, GCB, Stanbic Bank, Fidelity Bank, and AFSA, they are all reporting return on equity in the 30s. So you'll be wondering that if return on equity is that high, why would these banks be valued at a price to book more than 1? We'll look into all those things. So I provided further statistics below. You see the loan year on year and the deposit year on year. In exception of 2020, you see the loans and deposit tend to have a similar trend. See how nicely they were moving in 2022, then the decline in 2023, of course, because of the economic hardship and all that we have, interest rate was very high, right? And it started rising again. And you see the deposits rise 60% and 59% in loans, and that's quite interesting. I may have to take another look. I know these figures are correct, but sometimes when you see it, you're still afraid. Look, see how significant this is. Look at return on equity. 39.8% last year and has reduced to 32%, but it's still healthy. But in 2022 was negative 25%, and you all know why. It was because of the COVID, the DDP. Now, so that's GCB. Just a snapshot. So here, going forward, it's time now to take a deep dive into the numbers in SL. So GCB is a focus now. And before I move into Excel, I want to ask about your thoughts so far, because now we are transitioning to Excel, and we may not be using PowerPoint much again going forward. It's going to be Excel, and so I think I'll get back to the valuation side, and before we may get to look at PowerPoint again when we start thinking about valuation. So for now, it's going to be Excel throughout. Let's start that now. My arrangement, how I structure my Excel, at least now, is not, I don't have all the slides here, but I have as many as possible, at least for the historical now. And those are things I'll be sharing with you as well. But before I share, because I don't have the historicals for the comparables populated, they have to be populated before we have that shared with you. Now, but let's just go through some few things here. And I'm going to walk you through this because I placed in the formulas. And let me explain why. If I don't do it like this, it will be difficult for me to complete this within this period. But this shouldn't be too difficult for you, for you to follow. You know the key things on the financial statement, the balance sheet. We have the funding, where the bank is getting the money from to fund the asset. And if I say fund the asset, I mean the loans and investment securities. And basically, we know the bank get the money from deposits and also from borrowers, right? So we need to have analysis of the customer deposit. And so we have the funding here. Then where the money goes to the earning assets, and this has to do with the loans and the investment securities. And this is where you see impairment and all those kind of stuff. Well, we covered here. Then revenue becomes a big thing. So of course, when the funds are raised and the loans are financed, they translate to revenue, right? So you see in the likes of the interest income, you have fees and commission income, all those things here, and net trading income and other components of income, which are actually not revenue, but I place it in this slide. Cost side is here as well. You have interest expense, fee and commission expense, personnel expenses, and other components of expenses or other expenses, all listed here. And other balance sheet items on the balance sheet like investment in subsidiary, investment in associates, investment other than securities, that more of equity investment, right? Non-pledge trading asset, other assets and liabilities, employee obligation, current taxes, deferred taxes, and all that. Fees asset side is also here. And you have the PPEs. And one thing I did for the fees asset side is that I combine all the fees assets together. I call all of them PPE. And then I did analysis on them on a consolidated basis, right? Then I also have intangible assets also here presented. Then equity, stated capital, the retained earnings, the statutory reserve. We have credit risk reserve, fair value reserves, other reserves. As per the financial statement, that's how I arrange these things. The slide here called cash flow analysis. I place it here because going forward, how we're going to be forecasting a cash flow statement, we will need some adjustment to be able to get things like the total loans the bank actually granted this year, and also total deposit the bank actually mobilized in terms of cash. You cannot just take the balance sheet and look at the movement in deposit and say that's the total deposit the bank mobilized. That's not true. That's not correct. So what we're going to be doing here is that I want to walk you through some few things, because that's the reason why I spent time talking about them, right? Now, so when we come to the funding side, the bank funds itself from three sources. When you go to the balance sheet of GCB, the funding comes from three sources. As I mentioned, I'm going to share this with you. The funding comes from three sources. Customer deposits is this, and also the deposit from banks and other financial institutions. also this, and then we have borrowings. Borrowings, the borrowings the bank made. Then this at the top here is just a summary of all that. I don't know why my Excel has decided to freeze. Okay, it's working now. All right, so we have customer deposit here. And then when we look into, you see the CASA. But here, the way GCB presented it, we have the current account, then we have savings account separately. So the combination of the two gives us a CASA, right? Current account, savings account. So when we're looking at this and we're like, oh, current account, savings account, or CASA dominates, this is what we mean. If you take the current account percentage of the total customer deposit and you add that to the savings account, that's about 84% in 2019. And by 2024, it gave us 91%. That's where you're getting it from there. Increasingly, you could see that the bank is actually dominating in the CASA market, or its deposits dominating in CASA. But what am I doing here? When I take the historical figures like this from the notes, I type all of this from the notes already. I can calculate the customer deposit growth, that meaning the total growth, or the growth in the total customer deposit across. And also, I want to do the year-on-year on each of the components of deposits. I did that. I also did year-on-year on savings, time deposit. I did that because I want to see the rate at which they are growing. And one thing I want to also see, apart from year-on-year, is the relative. What is the percentage of current account to total customer deposit? I want to see that as well. So before I even move there, look at the formula here for the simple growth, the year-on-year growth. I put in this error handling function that in case there's an error, put there not applicable. And because I'm doing year-on-year growth, the first year, I don't have the previous year to calculate that year-on-year growth. Therefore, it's going to be not applicable. And then it starts giving me the rate of growth going forward. It starts giving me the growth rate going forward. Start giving me the growth rate going forward. I said that I am not going to use PowerPoint going forward, but let me take an exception. I'm going to do it. The reason why I have to do it is that when I do the historical analysis, I may want to present in a PowerPoint. And side by side, I want to present also the top 10 performing banks or top 5 performing banks so that we can, I'm sorry, guys. So that we can compare GCB's performance against the top 5. We have to do that peer benchmarking before because it's going to help us in developing assumptions, right? And justifying our assumptions. And also we may plot some macro variables alongside. Okay. Now, so when I'm calculating the percentage, look at a simple formula like this. I'm just taking a current account divided by the total. That's what I'm doing. So time deposit is, by 2024, time deposit is taking only 8.6% of total deposit. And so it kept declining. In 2019, it was 15.3. 2020, it was 16.3. It just increased. Then it increased further in 2021. Then it declined to 15%. Then 2023 to 13. And now it's only 8.6. Well, the bank strategy had been over some a year or two ago to actually grow the CASA. And so you can actually start seeing that the CASA, the growth or that strategy is reflecting. CASA is dominating now. CASA is dominating seriously, right? Now, these are the customer deposits, right? And then we also have deposits from banks and other financial institutions. Oftentimes, is lower. Because even if you look at customer deposits as total, as percentage of total funding, you see customer deposits taking about 90%. Look at the average. If we do the average calculation somewhere here, the average over the period, customer deposits as percentage of total funding, you see that it's around 91%. Customer deposit is taking 91%. If you look at it in terms of deposit from other banks, it's only 3.2. So deposit from other banks, 3.2, it's not quite significant. So it's not something we really waste our time on, right? The critical thing is the customer deposit. And borrowings is taking what percentage? On average, borrowing is taking, let me just calculate this average for you to see. Borrowing is taking about 5.8%, right? Borrowing is taking about 5.8% on average. It's even higher than deposits from banks and other financial institutions. Now, guys, what I'm doing here, you will see that I've calculated the ratios down. I've done that, and this should be simple to do. I'll share this with you, and you should understand why I have to calculate this down. I have to calculate this down because if I have to come to the class here and do this, it will take a lot of time. What we are going to spend our time on is the interpretation of the ratios, the historical performance. That is a key thing. The actual calculation, I'm sharing the spreadsheet with you, and it's very easy to do. Okay, but you see clearly that the choice of calculation I'm doing is that I actually tend to do the year-on-year growth, and also I tend to do the percentage of the total. Right. So you'll see borrowings doing its own thing there. You know, once I look at the funding, maybe the natural side may be for me to start looking at earning asset, but no, I want to complete the discussion on funding. I've already created a space down for the forecast, which we will be doing. So there's space for forecast. So from here to here is just historical, and then the forecast follows from here to here. But I want to complete the discussion, so I'll go to interest expense. Let me see whether the deposit the bank is mobilizing, whether it's cheap or it's expensive. So when I come to the cost side, I come down straight. I don't want to look at the cost as it is here. No, this is the summary, and it has interest expense, fees and commission expense, personnel expense. No, I'm interested in interest expense because that's the one that has something to do with the funding. Let me see how expensive the funding is. Now, GCP, when they are reporting interest expense, they report the current account and savings account together because we all know current account attracts nothing. Therefore, all the cost goes to savings account. So just report all of them together. CASA, right? Current account, savings account. So maybe let me just put it in here as CASA. That will be fine. Current account, savings account. And if you check it out, you see that there are some few things I wanted to check. Number one, guys, let's check the growth is not quite of a key thing when we do bank financial modeling. The growth in the interest expense is not something we even think about much like that. Yes, you can do it, but it is a bit meaningless because the P&L is driven by the balance sheet. The balance sheet drives the P&L. So what is actually driving the interest expense is the foundational driver or the fundamental driver is the deposit and the borrowings. So it's not about year-on-year growth. It's about deposit and borrowing, right? So even though I calculated the year-on-year growth, it's not quite of an important metric to me, right? The key metric to me is not also the percentage of each of the contributors, right? But the key metric to me is when I express interest expense over. But before we get there, let me correct something here. Before we get there, I want to do this. I want us to see the percentage of interest costs that's coming from the various sources. So if you look up here, the average of, let's say, for CASA is contributing about, on average, about 36% to interest costs. Okay, CASA is contributing 36%. Meanwhile, you know CASA's percentage of total funding. And CASA was given about 91% to total funding. But if you look at CASA here, CASA is only contributing 36% to the interest expense. Okay, but I wanted to look at something more. You see that this has been declining. Well, it's a bit erratic actually. It increased from 37 to 39%, then increased again to 42, declined to 35, declined again to 29, then increased to 33. Well, that's a proportion. And don't be quick to judge. The increment may not necessarily be because interest rate is rising. The increment may be because there are more CASA deposits that are mobilized or more of savings accounts deposits are mobilized. In fact, when you go back to the funding and you check the savings account, let's check savings account. Savings account over time has actually been declining 42% to 41 to 38, then declined to 37, then up to 38, then down to 37% of funding. It's not quite of any significant decline. It's more erratic, but it's around, it's within the same a very close range, right? But if you look at CASA, current account that doesn't attract deposit interest, you'll see what is happening. It has increased from 41 to 42, and that was the same time that savings account declined. Then increased to 43, savings account declined to 38. Increased from 43 to 46, savings account declined further. Then increased to 48, savings accounts increased slightly. Then increased to 53. You see that current account is actually on the increase. And that's a good thing with GCB. I'm just amazed. I'm just in love with this bank, how some of these things have been managed, right? If you look at the cost element of it, look at CASA cost. Look at CASA cost, 1.8%, meaning on average, this is the cost of funds or the interest expense for CASA. So what we did is that we expressed the interest expense for CASA over the total CASA. But here we are using average. So beginning CASA balance and the ending per CASA balance, the average. And that's what we do. So we do the interest expense for CASA divided by the average CASA balance, right? 1.8, increase slightly to 1.9, slightly to 2, then maintain at 2, decline to 1.5, decline further to 1.4. And you'll see why it's declining. Let me explain to you, ladies and gentlemen. The reason why it's declining is that savings account is the only contributor to interest expense. So, and we also saw how CASA or how current account has been growing. Current account has been growing, savings account has been declining. And if savings account is the only contributor to interest, if you express the interest expense as a percentage of the total CASA, you have to see that declining. So that has declined significantly. I think there's a question. Please, no call account. Yeah, no, no call account here. No call account. No call account. Now, thank you. Now, when we look more into this, let's see the time and other deposit. Time, here I mean the time deposit. If I say time and other deposit, I mean any other deposit classified as time. Look at how expensive that is. 13%, 12.2, down to 10.7, up to 12.6, up to 14.9. Oh, this 14.9 makes sense because of the high interest rate in 2023, right? 2022 and 2023. Then down to 9.6, 9.7. And it's expensive. And that's more reason why GCB wants to go for CASA, want to improve on the CASA, right? Then average cost of funds, I think average cost of funds here, let me just drag that here. So you see the average cost of funds. Look at the average cost of funds for GCB. On average, like if you take the total interest expense divided by total funding, this is what you have. But as I mean, not just total funding, but the average funding, the beginning and the ending balance, right? The average. This is what you see. Now, guys, think about the relative stability in this figure. Can't you see that this figure is quite stable? It's just amazing, man. Look at how stable it is. Look at the stability. I want to do something here. Let me put the error formula here. If error, otherwise not applicable, so that I don't have this zero divisibility, indivisibility error coming up. So no, I'm going to make a mistake if I do this. Okay, I think this will work. Yeah. So this gets, yeah, right now. Now, guys, just look at how well the bank is performing. Just look at the average cost of funds. Quite stable, right? And if you check the average of these, the average of all these is about 3.8%. 3.8%. That's the average of all this. And you see where it's coming from. Borrowing is giving them headache. Look at cost of borrowing, average cost of borrowing, or effective cost of borrowing, average effective cost of borrowing, 17% in 2023, 22% in 2024. Of course, you're actually competing with the government to borrow, right? So you are likely to have those things. at those high rates. So that is the funding and the cost for the bank. So you'll see that it will be easier to forecast things like this, because if I'm looking at the average cost of borrowing, cost of funds, and it's quite stable like this, it's very easy for me to forecast what the next one is going to be, right? Even if I'm looking at CASA cost of fund, look at how stable it is as well. And you can see time and deposits and co declining. As interest rate is declining, I don't have to forecast the time deposit at the average, because interest rate is declining. It's taking a downwards decline. A downwards trend here tells me that I want to say trend, I say decline. A downwards trend tells me that it may even get better, or I can maintain it at this rate when I'm doing my forecasting. Now, so we are finished with the funding, the review of the funding, but not entirely finished. The reason is that when we do this review, we are doing the funding separately, and we also interest expense separately, but at a point, we're going to bring all of them together, okay, and do the review together. In terms of, I'll now compare loan to deposit ratio, I'll now compare things like, I'll now do net interest margin, which will now take all of them together, right? So we are going to close here for today, and on Monday, we'll complete the financial analysis and start the modeling process. That's how it's going to be like. So it's 7:37 by my clock here, and I want to say once again, good evening. And this has just started, and I believe it's going to be a very interesting discussion we'll be having. And stick around, because there are more interesting stuff we'll be talking about. We've just started this, and in interest of time, we want to close, and then we can look at this more on Monday. Any question? If there's any question, please put something, as I always do. Put something in the chat. Let me hear from you. How you are feeling in terms of what we have been talking about so far. And as I mentioned, the notes will be shared over the weekend. So let me hear from you. What do you think? What have you learned today? So maybe put something in the chat. Your experience for today, good so far. We will await course next. Yeah, you'll definitely get what is next. Amazing lectures. Very easy to digest. Thank you, Julius. Thank you too. No, good so far. We'll wait. What's next? Yeah, definitely. I need some few remarks as well before we bring the curtain down today. Who else is saying something? Okay, so Ifri, up to you. Sorry, over to you. Over to you, Ifri. Please proceed.
Hi, Julius. I'm here.
Great.
Yeah, I don't have any announcement today. The only thing is that I'll be receiving the slides and things from you, right? And I'll share it with them on Monday, ahead of our session on Monday, so that they can have access to it. So that's all from me. Thank you, everybody. Thank you, Julius, for today as well, and enjoy your weekend.
Thank you too, and same to you all. Happy to have you here.